the key here is that the two of you have a difference of opinion when it comes to market value. You believe that market values are going to be going up substantially higher in the near term, whereas the owner believes that property values will be dropping in the near term. So now, even though you believe that that market values will be going higher in the near term, it's a considerable amount of risk to go out and buy, say, a $300,000 property and hope that property values go up. So what you do is you contact the seller and you say, tell you what, let's draft a contract, and I'll pay you $10,000 for the right to buy your house at its current value of $300,000 anytime between now and the end of the year. That way, should property values go up, you have the right to exercise that contract, buy his house at $300,000 plus the 10 you paid. That's a total of $310,000. That's your total cost. But if property values go up, and now by the end of the year the house is worth $350,000, okay, you can turn around once you buy that house from him at $300,000. Turn around and sell it immediately for a $40,000 profit. Okay? That's your goal. As the seller, he's thinking property values are going to be going down, so he's more than happy to sign that contract with you. Take your $10,000, because if by the end of the year, say the house is now only worth $250,000, you, as the smart buyer, will let that option contract expire, because it'd be much better off for you to lose your $10,000 than it would be to exercise and pay $300,000 for a house that's currently on the market for $250,000. Okay? So in his case, if he's right, he gets to keep his house and your $10,000. And if you're right, you get to buy the house at $300,000 plus the 10 you paid, and you now have an asset worth $350,000. That's the basics of how a call option works. Same thing. If you have, say, Apple stock, I believe it's around the $100 price level right now. If you think it's going higher between now and, say, the November expiry. And by the way, expiry dates happen, the monthly expiry dates happen the third Friday of every month. Okay, that's when the equity options expire. There are many with weekly options, but we'll talk a bit more about that later. But let's say you believe Apple's going much higher. So you're going to go out and buy the $100 call for November. Let's say it's trading for $5. I don't have my charts in front of me. But should you be wrong and the stock drops, that's your total risk, is that those $5. Okay? Should you be right, you can exercise, buy it at 100 plus the $5 you paid. If it's, say, at 120, you've got a $15 profit. Okay? So moving on. A long call, the profit potential is unlimited because the underlying stock price can go, through the roof. There's no limit there. But your loss is limited by the premium that you pay for that call option. If you're short the call, then you're limited, the profit potential is limited to the premium that you received for the sale of that call, whereas your potential loss is unlimited because the stock can go up as high as it wants. Think of it this way. If you don't already own a stock and you sell a call, then that's what we call naked selling. So in that case, if the buyer exercises that call, that forces you to deliver that stock. Since you don't own it, you have to go out in the marketplace, buy it at its current value, and sell it. And that's why the risk is unlimited on a short call. With puts give you the right, again, but not the obligation, to sell a specific stock at a fixed price, known as the strike price, okay? Anytime up to expiration. The put seller, on the other hand, is obligated to buy that stock from you at that specified price if you exercise that contract. Now, for a long put, the potential profit could be substantial and increases as the underlying stock decreases on its way to zero. Your potential loss is limited to the premium you paid for the put. So again, whether it's calls or puts, if you're buying, your loss or potential loss is limited to the amount you paid for that call or the put. Okay? The short put, your profit potential is limited to the premium received from that sale, same as the call. The potential loss is substantial and increases as the underlying price decreases. Now, the fact that it's not unlimited is only because a stock can't go below zero. Once it hits zero, that's your limit. So, but your loss can be substantial. Now, option premium. One option contract is the equivalent of 100 shares of stock, of the underlying stock. So think of it this way. If you're buying one call option and that call option costs $1.50, you would have to multiply that by 100. So your total cost to buy that one call option contract would be $150. Okay. What can you buy options on? Certainly stocks. There are thousands of optionable stocks on the U.S. markets, as well as now there's hundreds of weekly options that expire every week. Apple is one of them. They have weekly expiries, which have become a great vehicle, an inexpensive vehicle to help you protect your positions in the short term and also take advantage of the types of swings we've been seeing lately in the market. And they're adding new ones all the time. So that list of weekly expiries continues to grow. You can also purchase options or sell options on stock indices. One of the most popular is the S&P 500, the SPX options. You can also trade options on futures, something like crude oil, gold, wheat, even currencies, just about anything these days. Now, why would you want to buy an option? First and foremost, for protection. Remember, your risk is limited to the price you pay for that option. So you can think of protection in a couple of different ways. Number one, let's say you're already long the stock. You say you bought Apple at $90. It's now at $100. You want to preserve that profit. You don't want to lose it. So you can go out and buy, say, a $98 put for $1. Okay? Yes, you're risking that $1, but you will have that right to always sell Apple at 98. So it doesn't matter if overnight, the company goes bankrupt and the stock opens, say, even it can go to zero, but I'm saying even let's give a realistic example. There's bad news and it gaps lower, and the next day it opens at $85. You still, because you're long that put option, you will have the right up until that expiry date of that option to sell Apple at $98. So that's one way to use it as protection. The other way is just to limit your risk. Again, with the first example I gave you, if you think it's going higher, but you don't, and you want to buy, say, 1,000 shares of Apple, since it's trading at $100, that would cost you $100,000 to open that position. But with an option, if you buy an Apple call, say for $1.50, and you buy 10 contracts, which is the equivalent of 1,000 shares, that would cost you $1,500. So a huge difference, 100,000 versus $1,500 of risk, and especially in the type of environment that we're seeing lately, where regardless of what the technicals are showing you on a chart, you have one huge update where you think, okay, we're back in uptrend mode, and then the very next day it erases all those gains from the previous day and sells off hard. And having options for protection is a great idea. The other reason you would buy options is for profit. And again, you can control a huge position for just a fraction of what it would cost you compared to buying the underlying shares of the stock. Now, there's a number of terms you'll hear a lot when it comes to options. One of them is in the money. What this means is that a call option with a strike price that is below the current market price of the stock, or a put option with a strike price that is above the current market price of the stock. That's what we call in the money. Out of the money is the opposite, when you have a strike price, a call option strike price that's actually higher than the market price, or a put option strike price that is lower than the current market price. At the money means that your strike price is very close to or right at the same price as the current market price of the underlying. A couple other terms. Intrinsic value. This is what we call the in-the-money portion of the option premium. In other words, if a call option, if it has strike price of 15, but the underlying stock is trading at 25, then you have an intrinsic value of $10 in that option, because that's the in-the-money amount. Okay. Extrinsic value is otherwise known as time value, the difference between an option's market price and its intrinsic value. So using that example from above, if the call option, the actual price of the call option was say $18, okay, we know that since the strike price is 15 and the stock is trading at 25, we know there's $10 right there of in the money portion of intrinsic value. Okay? If the actual price of the call is 18, then your time value or the extrinsic value is the other $8 of that cost. In other words, the further out your expiry date is, the higher your extrinsic value or time value will be. Okay, the higher the portion, the greater the portion of that overall cost of the call or the put it will be. Implied volatility, extremely important when it comes to trading options. This is the estimated volatility of a security's price. Okay? In general, implied volatility increases when the market is bearish and decreases when the market is bullish. This is because most people see a down market as a much riskier market. Okay? Typically, the downtrends happen a lot quicker, and that's what people associate with risk. And that's why when the market's dropping, volatility will increase, and vice versa for uptrends. Now, the Greeks. Now we're getting into a little more of the complicated terms here, and if you're just starting out, this may confuse you a little, but also these are very, very important tools when you're trading options. Number one, delta. This is a measure of the rate of change in an option's value for a 1 unit change in the price of the underlying. So let me explain. If you're buying, say, let's go back to the Apple computer example. So you're going to buy a call option of Apple. Apple's trading at $100, and you're going to buy a 105 call for November, let's say. Let's say that call has a delta of 30, okay, or 30%. What that means is for every dollar that Apple stock moves, your option will move 30 cents, okay, or 30% of that move. That's what the delta is. We'll talk a bit more about how you can use that later on. Now, gamma is a measure of the rate of change in an option's delta for 1 unit of change in the price of the underlying. So in other words, that first dollar that it moves after you buy that option, your option will move 30 cents with a delta of 30. But at that point, your gamma will start to increase. So your delta will move, say, from 30 to 35. So now the second dollar of move in the underlying will now move your option 35 cents rather than 30. Hope that's clear. Then there's theta. Theta is a measure of the rate of change in an option's theoretical value for a 1 unit change in time to the option's expiration date. So let's say now that you have 30 days to expiry of your call option. Okay? There's a formula with theta that will tell you how much your option value will drop every day if your underlying stock remains where it is. So in other words, let's say your theta was 10, okay, and you bought the call for 150. You have 30 days to expiry. The stock's not going anywhere. It's just flat. It's trading flat. every day that goes by, okay, if your theta was 10, I know the numbers aren't exact, but if theta was 10, you would lose 10 cents in value of that option every day. Okay, and now of course the theta will fluctuate, but and luckily for us, we don't have to do these calculations manually or in our head. It's all done for us by our charting platforms. Vega is a measure of the rate of change in an option's theoretical value for a 1 unit change. So similar to gamma, Vega is to theta as gamma is to delta. Okay. Now, delta and theta are the two most commonly used of the Greeks. Okay. Gamma is watched as well, but generally, especially for the option traders that aren't very experienced, delta and theta are the two that are looked at. Gamma and Vega, not so much. Rho here is hardly ever used. Most people don't even know it exists. It is a measure of the expected change in an option's theoretical value for a 1% change in interest rates. Now, with the environment we've been in for many years, and with such low interest rates and no movement, it really is immaterial. And again, for this to really impact you, you'd have to have some very sizable positions on. Now, why are options so risky? One, again, they're only risky if you don't know how to trade them. They're actually extremely safe if you do know how to trade them. But they're considered risky, and especially for call and put buyers, for option buyers, because over 80% of all option contracts expire worthless, and that's a fact. Now, most people only buy options, and the unfortunate part is that they do so without looking at fair value or implied volatility. Okay? In other words, what ends up happening most of the time is they will buy an overpriced option and end up losing money even though the underlying stock has moved in their favor. Okay? That is the reason why over 80% of all option contracts expire worthless. Remember, if you don't know what you're doing, it's extremely risky, and that is because most people don't, and they don't take fair value or implied volatility into consideration, and they jump in when the chance of them losing money on that is extremely high. When you do know what you're doing and you can calculate your fair value and implied volatility, you can do extremely well. Now, when you're buying options, there are 5 scenarios that can happen once you buy an option. Okay? Just as there is when you buy a stock. Let me explain. So, whether you're buying a stock or an option, there are 5 scenarios. 1, it can move in your favor big time, make a big move in your favor, or it can move slightly in your favor, or it can do nothing. The stock can move completely flat. It can move against you slightly, or it can move against you in a big way. Okay? So when it comes to buying options, this is where you will make money. If it moves in your favor by a wide margin, you will definitely make money. If it moves in your favor by a small margin, it really depends on whether you've taken the fair value and implied volatility into consideration. If you have not, you won't make money, not even if it moves in your way slightly. Okay, you'd have to be very lucky, because again, chances are you're overpaying for that option to begin with. Okay? If the stock moves flat, you're definitely losing money, because remember the theta, every day that goes by that your stock doesn't move, you're losing money on that option contract. If it moves against you, you're definitely losing money. And if it moves against you in a big way, you're losing a lot of money. So your chances of making money when you're buying options are really, the only guarantee is if it moves in your favor in a big way. Okay? And you might be able to make some money if it moves slightly in your favor if you really know what you're doing. Otherwise, you're going to lose money. When it comes to selling options, it's quite the opposite. Again, same scenario. There's 5 ways your stock can move. Okay? It can go in your favor big time, slightly, it can do nothing, it can go against you slightly, or it can really go against you. But if you're selling options, number one, if it goes in your favor, you're going to make money. Okay? And so let me explain. If you have calls, obviously you want it to go up. If you have puts, you want it to go down. That's why I'm saying in your favor rather than up or down, because it depends on whether you're trading calls or puts. But it's the same thing. So in other words, if you're sold an option, whether it's a call or put, if it goes in your favor, you're making money. If it goes slightly in your favor, you're going to make money. If it does nothing, you're still going to make money, because remember that theta decay, you're actually collecting that. When you sell an option, you want that option to go down in value, so you're still making money. If it goes against you slightly, you would still make money, okay? Because there's the proper way to do this. If you know how to sell options fairly, you will make money. And if it goes against you big time, that's the only scenario where you will be losing money. So when you're buying options and you know what you're doing, you have a 2 out of 5 chance of making some money. If you're not sophisticated, you really don't know what you're doing, you have a 1 in 5 chance. When you're selling options, you have a 4 out of 5 chance. Okay? It's dramatic. Here's a graph of the time decay. So, and this is where theta comes in. The longer you have to expiration, the better you are as a call buyer, because when you have a lot of time before expiration, the theta decay is gradual, very gradual. So during this time, see, from 120 to 90 days, that's a full month. During that time, you have very little theta decay, yet you have that opportunity for your stock to make the move that you're expecting within that time. So it's much easier to profit that way. Look what happens when you get down to 30 days. The last 30 days, look how dramatic that drop-off is for theta decay. Now, and imagine if you're trading weekly options. Weekly, you'd be about here, right? The last quarter. I mean, it's a steep drop. So when you're selling options, that's exactly what you want. Okay? Now, there's many option strategies out there. There's dozens. And you can even use combinations of them. But you can do long calls and puts, protective puts. There's several combinations of spreads, calendars, credit, debit spreads, butterfly spreads, which can be very interesting. Straddles, strangles, iron condors, collars. Many of these are very, very safe to trade, again, if you know what you're doing. The key is to really understand when and how to use each of these, okay? You don't need to trade them all. You just need to trade the ones that make you money, okay? Now, we are getting closer to our time allotment. If there's a couple questions, well, we can go over that. Sorry, I'm going to be bringing in my producer here, Raul, so he can read off some of the questions. If you have anything, please type it in, and we'll make the most of these last few minutes.
It's always a pleasure to join you here. Special thanks to the Investor Inspiration crowd for having us back.
Absolutely.
It's always nice to be at these events. When you're trading naked options, you don't actually have to be naked. Can you just clarify? That's for my own personal.
Absolutely. Keep your pants on. No. No, it just means you don't own the underlying already. That's exactly it.
Jeff is asking, what are your thoughts on weekly versus monthly options?
Weekly can be fantastic, especially in a market like this. When you have increased volatility, you get higher premiums on the weeklies. And there's a lot more movement back and forth, which creates opportunity. And now that we're officially into earnings season, there's a lot of opportunity with weekly options. So they're great. You know, not many people have jumped in yet. Again, the number of stocks that have weekly options are quite small compared to the ones that have monthly expiries, but the number is growing all the time.
Sarah's asking she'd like to start trading some more complex strategies. How do you place orders, for example, for condors and butterflies? Can you show us an example?
You know what? Unfortunately, it's quite complicated. I don't think I'd have the time right now to show you that. Maybe I should just carry on. I want to say one thing. Since we have very limited time, I haven't been able to get into the more complicated strategies. I have just highlighted the basics for you, and the key with options, again, is not only knowing when to use them, but how, when to employ each strategy, and how to carry out that strategy. Now, you know, we haven't been able to get into that. We need a lot more time, but for those of you who are really interested in making money with options, we have a live class coming up, our pro class for options, next Thursday, October 16th, from 7 p.m. to 9 p.m. Eastern. I myself will be teaching the class. It will be recorded, and this is what I'm going to show you. I'm going to show you how to create a steady weekly income using credit spreads. Credit spreads can be very effective, very little risk, but again, in this environment with higher premiums and so on, it could be very lucrative. Now, you can use the same strategy on monthly expirations if you prefer that, but credit spreads are key. Also, butterflies. We will show you a way where you can risk just $90 to make a $1,000 profit using butterflies. Butterflies are one of the more thought of as one of the more complicated strategies, but we'll show you just how simple it can be to put one on and take one off, and do so with extremely, extremely small risk. Okay? Also, there are many delta neutral strategies that you can employ to make money in any market, whether it's going up or down. And again, this is the perfect environment. You have strong up days, strong down days. But again, in this kind of environment, if a trade were to go against you, we'll show you ways where you can quickly repair that trade using some of these strategies. There's a lot of material to cover. It's a 2-hour class. Typically, we go a lot longer. Okay? And also, the other thing we do the second half of the class is actually go through our charts and try to find trades setting up for the coming week, and then show you exactly which strategies you could use to take advantage of those trades and how to put those on. Okay, the link for this is tradingwins.com/intro. And again, we're actually going to give you more than just this. Let me show you what you get when you sign up. Number one, you'll get a seat to the live options intro pro class on the 16th, and that's a $397 value. But we're also going to give you a complimentary invite to our coaching mastermind session. Now, mastermind sessions, we used to do these a while back and then had stopped due to my scheduling difficulties, because I do personal one-on-one coaching as along with these classes. But before, we used to have this mastermind group where we'd take 10 traders, and we'd have 4 sessions a month, and I would teach them to take their trading to the next level. So in other words, when you join us, you let us know where your trading is at, where you want to get to with your trading. And with a small group of 10, we can coach you there. Now, we started this again a couple weeks ago, and we have a class going on Fridays, but the demand has been even greater. We're going to add a couple other classes, but we thought we'd give you a look, and even tomorrow, Ro, they can join tomorrow's class?
They can, depending on how many people actually want to.
So we'll give you a complimentary invite to that. Now, those sessions are 2 hours in length, and they're quite sophisticated, so there's a lot of material covered, and it's like having a whole other pro class. Also, we're going to throw in a 30-day membership to our pro service. Now, what our pro service is here at Trading Wins, we create video recaps every night from Sunday to Thursday. What we do is we recap the market action from that day, let you know where we believe the market's going next. We review our open positions and highlight new trades setting up as well for our members. And as we go through the charts, there's a number of technical analysis tidbits that we cover. The whole purpose of it is to be an educational tool and to help you further your trading, and along the way we share the trades we take. Now, in total, this is a $744 value, but we're not going to ask you to pay that today. Anyone on this webinar, it's just $97, okay, for everything. Now, again, it's tradingwins.com/intro. Unfortunately, we do have to cap this at 25 people. For the pro class on the 16th, we typically have people with different backgrounds, different levels of experience, and we're going to be getting into a lot of the more complicated strategies, the higher level strategies. So it's going to take some time to show you using the analysis tab on my charts exactly how to employ these strategies. So with all the questions we expect to have, we cannot have more than 25 people there. Okay. Now, we're not interested in selling you anything you can't use. So for any of you who do not like what you see, we offer a money-back guarantee, absolutely, and also our 30-day membership to our pro service. Okay, if you enjoy it, you don't have to do anything. It will automatically renew at the $97. If you'd rather not continue, you can give us a call and cancel anytime. Okay?
Vince, amazing offer. It's you'll make back that money on probably one trade that you'll get from the session.
Absolutely, especially in this environment. Even if you're writing options, even on a weekly contract, you can get much more than that.
All right, I got a lot of questions.
Sure.
I'm going to go rapid fire on you.
Yeah, as long as we have some time.
As many as we can. Let's start with the most recent one first. Peter wants to know, do you teach us how to set up trades?
Yes, again, not only will we start from the beginning and show you the actual strategy, how it's built, what your maximum risk is, what your maximum reward is, all that kind of stuff. But again, the second hour, when we'll bring up our charts and go through, try to find some decent setups for the coming week. Once we find those setups, so I should say there's actually, in addition to the options portion, when we go through our charts, we'll be teaching you what kind of setups we look for.
That's what Susan was asking. She's a current member and previous student of yours to the Our Favorite Trade setup, as well as the 3 Simple Steps to Profit. She's asking, will you be using those setups to actually identify options setups? Yes,
we'll be using several of our systems. Whatever we see on our charts and identify as good trading opportunities, we'll then show you which option strategies we would employ on those setups and how to actually put that trade on and then take it off, what to look for, et cetera, et cetera.
So it's like getting the benefit of 3 webinars in one.
Yeah, absolutely.
This will probably be a 3-hour class.
Yeah,
right?
No doubt, no doubt. They do tend to go longer, but again, if you only have the 2 hours, or if that date doesn't work well for you, you might be overseas, et cetera, the event will be recorded. You'll receive that recording shortly after the event is over. And as always, I would encourage you to watch it at least twice over the week following the event. Make sure you have all the concepts down pat.
Just a quick strategy question. Nancy has been asking this. She asked a few minutes ago. Your opinion on selling covered calls versus buying puts?
You know what? It's all a matter of risk. There's arguments for both. And you know what? In the class, I'm going to show you a unique way to use both. Most people would buy a put to protect the stock position in the way that I mentioned earlier. In other words, you own Apple shares which are trading at 100, and you buy a $98 put for that downside protection. I'm going to show you another way where you can actually pay even less for it, take on less risk, but still leaving your upside wide open.
We've got about 4 minutes left. I've got probably over 100 questions, so I'll see if I can get through as many as I can here. The 25, Tom is asking, the 25 member capacity, is that a hard number?
Well, it is for that particular class, but if you were to join us today and that class happened to be full, we'll get you in the very next one. If you're not one of the first 25, you'll get in on the next one.
We realize this is a multi-speaker event. There are a lot of excellent speakers coming up with a lot of excellent information that they're going to provide, so it's not meant to create an urgency, but we do have to limit the class size because of the material and the way that it's presented.
Yeah, absolutely. But again, if you do want to take advantage of that mastermind session tomorrow, that is key. And that one, tomorrow's session is going to be important because what we are going to be talking about there is credit spreads as well as how to trade options during earnings season. So it's going to be an interesting class.
Domingo is asking, is the Mastermind and Pro Service only about options?
No, it's not. Actually, the Mastermind class, what happens is every week for the first hour I teach on a certain topic, and then the second hour we open it up to questions, and you're able to ask any trading related question. And again, it's great because we have some very, very experienced traders as part of that group and some not so experienced traders. So as different questions come up, we cover different topics on the fly, and it's a fantastic way to learn.
Terrence, Mark, Sylvia, thank you. We've got your order. Looking forward to seeing you at the Mastermind session and the session on the 16th. Marcus is asking, he's having some trouble getting through. It's tradingwins.com/INTRO. The phone number is 1-888-574-2426. One of the tech guys is going to put it in the chat window right now. We're also on live chat as well if you have any questions about the event either today or coming up on the 16th. Folks, there's really, you can try the service, you can come to the session. If for whatever reason you don't like it, and it rarely happens, how difficult is it to get your money back?
No, just give us a call. It's not, but as you said, it rarely happens. The amount of material we cover during those 2 hours, and sometimes it goes closer to 3, you know, compared to what you get for the $97, it's really a no-brainer.
Let me just see what other questions I can pick up. Peter, we're going to call you on the telephone to make sure your order goes through. We're sorry about any of the problems that you're having on the website. We do have quite a few people ordering. Vince, tomorrow's session on the Mastermind is focusing on what? Straddles, strangles, and credit spreads?
Credit spreads, and we're talking about earnings as well, since we're just kicking off earnings season.
And folks will get a complimentary recording of that if they join as well.
Yeah, absolutely. All those sessions are recorded. It's great because we have 4 sessions a month, 2 hours each, and so over time you build up quite the library of reference material to go back to. And but tomorrow's session is going to be key.
Avi's asking, can you use these strategies on Forex?
Well, you can more on the ETFs for the Forex pair. So, for example, FXY is the Japanese yen. You can definitely employ those with the currencies or through the futures, currency futures.
All right, we're half past the hour. Last time.
Oh, that's it. Okay.
Tradingwins.com/intro.
Really, really hope you can join us on the 16th. Again, if you can't, the session will be recorded. And really hope to see you at tomorrow's Mastermind. And again, thank you so much to
the Investor Inspiration crowd. Thank you again for having us back. Really enjoyed every time we're here. Your hospitality is always appreciated. Thank you so much, Vince. Always a pleasure. Thank you.